have a narrowing of the market. It's another sign that the bull market may be just the end, but just the end doesn't mean that it's really near the end, right? So we look at that now, the top five stock in S&P 500 are all tech, if you count Amazon as tech, which I think essentially they trade like tech, right?
Fairly.
So top 5 stock is all tech. It's probably the first time we've seen that. Even when I went back to the peak of 2000, top 5 stock is not all tech stock at that time. So it's really, really interesting. And the top 5 tech stock is around 13% S&P right now. By itself, it's around the 4th largest sector by itself, the 5 stocks, right? So it's a very narrowing market, and so worth worrying. But this thing can continue, right? The top 6 of the S&P 500 2000 was tech stock. 6 out of 10 of tech stock, not the top 6, right? 6 out of 10 are tech stock. And now the 6 stock at that time is a total market cap of 16%, right? So we're 13. Well, but the thing is that but none of the top 5 stocks now today has a percentage market cap as big as back in 2000. I mean, they were in the 4-ish handle. Now none of the stock is under 4%, right? So yeah, it's concentrated. The question is, can it go on? Well, it could, right? I mean, because we've seen that before. We've seen how the bull market keep running in '99, and everybody was skeptical.
And
right?
it would seem like my guess would be, any regulatory pressure that, say, a Google or an Amazon would have faced in the Democratic administration is probably off the table, even though, based on Trump's rhetoric towards Amazon and Google in the campaign, who knows? But I don't know if that plays into, the ceiling on these stocks at all.
Yeah.
The ceiling on the tech.
Yeah, or just does a view on deregulation play into further growth for tech?
I don't know. I get more concerned. I'm wondering, Chris, if your point on the dominance of the contribution being limited, if your concern was because of the correlation, or if it's because it's tech specific, which is implying, of course, cost consolidation in the future. I mean, usually if tech does well, it's because the corporates are more focused on containing costs as opposed to hiring, of course. So you're saying that you're concerned because of what reason? No,
I'm nothing. So I'm concerned. I'm not concerned. So if you look at just the normal statistically, I say is that at the end of the bull market, there seems to be some very concentration on the winners keep going, but the rest of the market is already not keeping up. So that's one phenomenon, just statistical basis, right? But then we look at the stock itself. So, okay, yeah, it's concentrated, but the first one is not as bad as 2000, okay, but doesn't give you a lot of comfort. And 2000 ended pretty bad. And you look at the 5 stocks that are leading, valuation, with the exception of the Amazon, we don't know what the valuation should be. The other one, it's actually not as bad as 2000.
Sure.
Thirdly, I think the world also has changed a little bit, is that now it's very dangerous to say the world this time is different, right? So I know that. And is that the tech world has become, because of the technology going on, is to become the winner-take-all market. When you're winning, you continue to win. You dominate the market. So now those tech company has a very strong market position that is very hard to replicate, right? And now things could change. Innovation coming, they can take them down. Just give an example, right? The top 6 stock in 2000, only one still stay in the top 5 today. It's Microsoft. Right? The other 5 top tech stock in 2000 is not in the top 10, not in the top 20 even, right? Things would change. I think you know that, right? So my point is actually 2 points. Right? I'm concerned because there's a normal phenomenon that is a sort of trusted end of a bull market. You have concentration, like 99 as well. Like we see a lot there because the rest of the stock is not coming up. And but having said that, we still very hard to time it. That's my point. Yeah.
Stuart, can you factor in the rhetoric of nationalism, isolationism, and what that means for the economy and for particular stocks? How do you even factor that into your allocation?
Again, I'm not sure it's a dominant factor. I think it's really hard to separate rhetoric from the reality or the likely reality. I mean, there's a lot of discussion about renegotiating NAFTA, for example, or exiting from Euro market-related contracts and so forth. And I think isolationism as a general issue has always been bad for the U.S. Or for any countries. Isolationism isn't good. The globalization enhances trading. You know, it's 1 + 1 = 3 for everybody. And so I think if any of this gains real momentum, it will have a dampening effect. Yeah. I think it's hard to react in the short run to some of the rhetoric just because it's virtually impossible to know what, if any, is going to play out.
Yeah, it's sort of the irony when you see Trump or one of his kids tweet out a graph of the market and, you know, how incredible it's performing under Trump. And it's like, it's because nothing is actually happening. It's not, you know, if your agenda were working, things may be a little bit different.
I mean, deregulation, I think broadly speaking, is another often talked about you know, political strategy. And I think a lot of what's been happening in the market thus far is anticipation of some deregulation. Yeah. I think that doesn't come without some risk. I think deregulating the financial sector is a high-risk strategy. And to the extent that a lot of the Dodd-Frank gets rolled back and a variety of the regulations that have really put a ring fence around, you know, too big to fail banks and that sort of thing, if that all goes away, I think we're back where we were a decade ago. And I think that is a high risk to the markets. Yeah.
What about true geopolitical risks? And you know, you mentioned having a finger on the button, but maybe not something that severe, hopefully, but other, you know, the odds of war being greater than they had been previously, or just instability globally. Is that part of the same story, or is there another? Or when you think about existential threats, is it just too much to factor in?
I'm not certain the market cares. There was a point, I think, in December, January, and heaven forbid North Korea launch a missile at this great state, and the market would have said, well, the Trump tax code is going to bring us to 15%, so let's go higher. There are points where there's less rationality or a rational mindset towards how things are valuing. I wouldn't necessarily fight the trend. Right now, the market has, geopolitical events have surfaced over the last several months, and there have, I mean, pick the one you want. Every single one of them could have destabilized the markets, and every single one of them, the market chose to go higher. The VIX went lower. That doesn't necessarily mean that there isn't fear.
Or volatility.
In volatility. I mean, if you look at the skew inside the VIX, the difference between in and out of the money prices of options relative to the at the money, that relative difference, you actually see the fear, even though it's not being priced at the money, which is where the VIX tends to reside. If you look at policy uncertainty indices, you see fear. So I'm not certain the market necessarily is doing something right in front of you to price that fear, but at the same time, I'm not necessarily certain that the geopolitical risks are captured in a way where you want to fight the trend at this point.
Or we could know the risks. I mean, you know, so this time last year, of course, we're talking about China. So we have to actually go to China to figure out they're not actually at war, and we're just hearing a bad story in U.S. media, right? Or Brexit. I mean, you don't know the news. Is Brexit actually, is it so bad it's actually a positive that now they understand the danger of populism and UK stays in? You don't know, right?
I'm not certain there's if you take a blank piece of paper, everyone in this room could write down probably 10 to 20 risks that exist out there from a geopolitical standpoint. I would venture to say not a single one of them will be the thing that destabilizes the market because it's known. Right. It's the bullet you don't see coming towards you that's going to get you in the most trouble.
But skew is determined by the masses. My point is if you look at North Korea, right, there's a general perception in America that is a huge risk, whereas not a single individual in Seoul possibly believes it because they know nobody's that dumb, they would lose in a second.
I don't think Dennis Rodman thinks that either.
Oh, well. And we use him as our top advisor.
Exactly.
So
And
there you
maybe,
go.
maybe we can talk about Potcoin, but I wanted to see if there are any questions. We got about 5 minutes, so couple questions out there. There must be, right? Talking politics, no questions? Come on, yep. All right, well, I'll throw this out, and maybe you'll get bored by this question when I ask something. The prospect of a more conservative Fed, does that change anything about how we haven't talked about fixed income assets much. Anything there? I'll just throw that out.
Well, we'll have an announcement in, 10 minutes?
That's right.
And,
but I think we know what's coming.
Yeah. So you're talking about the change of composition of the Fed,
Right, exactly.
right?
Yes.
So,
Yep.
so well, first we don't know how it's going to change, right? So we know it's going to change, but we haven't really know who will be the next Fed chairperson. And definitely that there will be changes from a move away from academic person to more market practitioner. That seems to be the case. Now, if that's the case, then actually, my view is that it's actually good for a stock market, right? So it's not going to be dogmatic following a certain academic formula for tightening rather than looking at the policy. If you're more people practitioner, they will tend to be more pro-growth. That's my conclusion, but we don't know the person yet, right? So it doesn't seem to be a big risk to derail the market in terms of equity side. On the fixed income side, same thing. I think the market you can see the fixed income market have done actually quite well, right? For many reasons, because inflation actually turned down, growth was weak in first quarter, so they did well for good reason, right? So I don't know how much they did well is because they're thinking about, well, if the composition of the Fed is going to change, maybe the tightening would not be as academic and as tightened as it would be, right? Because academically, you say that, wow, interest rates are way too low right now, right? From all the study whether real rates or was the Taylor rule and all the things like that, right? Rates are very low, right? But if it's more a practitioner, they say, well, I don't want to look at more the market to do with my policy. That's actually more pro-growth. So, I mean, and the reason why I think equity could do well with the new composition of the Fed. And fixed income probably can do well as well because it probably won't be that aggressive.
There's a cartoon out there that I came home one day and just kind of chuckled over it. I went to the University of Chicago, and I get their monthly magazine, and the top picture of the magazine was the 4 central bank heads. They're all in different superhero costumes with frowning faces, and it said, "Did the Fed lose its superpowers? Or do central bankers lose their superpowers?" And they all look so sad.
What about on the fringes? Is real estate potentially a more attractive asset given the administration's favorability towards that? Are there any areas where you're kind of again on the edges throwing a little more, a few dollars? Anyone?
I'm going to be the pessimist, so I better not. I better not.
Please, we like pessimism.
We're not a fan of much real estate. I think cap rates are low, interest rates are still low, and even if there's a gradual tightening, that doesn't change the prospect for real estate much. And given that the vehicles by which we would make investments in real estate tend to be longer term and longer tailed, we're looking elsewhere for opportunities that are niche or more focused strategies.
Yeah, then even with your 2% framework.
I mean, there's demographic changes that favor, maybe student housing or elderly care.
Incredibly expensive.
Or
no, that would be
all
great,
that sort of thing. But they're all pretty pricey.
Oh, that's because you're at a university. Are you selling something?
We had a manager. No, granted, we were high-fiving and we're thrilled to hear this, but it made us very nervous at the same time. The manager reached out to us and told us how they just sold a meaningful property at a 1 cap. And that, I mean, it was petrifying to even hear that. I mean, yes, we were happy with the results for us, but now that the money's coming back, what do you do with that? And who would buy something at a 1 cap? I mean, you have no ability with that piece of property to make money. Or maybe you do, but odds are against you.
Yeah, we've moved out of core into value add for that reason.
But there's probably some sort of non-economic buyer in real estate that cause real estate, some pocket of real estate market really crazy. And those non-economic buyers tend to be, a lot of them come from China. And but they're non-economic, so that's the thing. They're not buying because they want to make money, they're buying for other reasons. So it's good to sell to them, right? But you don't want to follow that kind of trend.
Well, I think the sovereign wealth funds have gotten into real estate
Sovereign
in a
wealth
way
fund as
where
well.
About, like,
they have
Chinese
to
sort of
put capital to work in such large amounts that you're just willing to pay anything and everything to get it working.
And you're saying to park their capital in a different.
Yeah, they're not park the capital.
Yeah.
Well, we got to wrap up. When Alex invited me to do this panel a month ago, he said, we want you to do a panel on Trumponomics, talk about finance in the Trump era. And I said, well, you got to have a plan B just in case he doesn't make it the next 4 weeks. But we did, and we got our top again. Thank you so much. Thanks, Alex, and enjoy the rest of the day.